Hello everyone and welcome back to an Introduction to Investing for Canadians, a series created to teach young Canadians the fundamentals of budgeting, saving, and investing. We're going to look at different types of registered accounts and then go into further detail on the tax-free savings account and the registered retirement savings plan. In Canada, the best place to purchase and hold investments is within a Canadian registered account. These are a type of investment account that is granted tax deferral or tax sheltering privileges by the Canadian federal government. In fact, there are 5 types of registered accounts with the Canada Revenue Agency. Each account is intended for different types of investment. In this video, we're going to look at and focus on the TFSA and the RRSP accounts. Now I know what you're thinking, this sounds way too good to be true. Tax deferral and tax sheltering for all your investments. But the kicker is that each type of account has limitations onto how much you can contribute each year. First up, the tax-free savings account, or TFSA for short. This investment account came into effect back in 2009, and it allows Canadians to place funds in the account and grow their investments tax-free. And we'll get into more of this shortly. You can open up your TFSA at your local bank or with any other investment brokerage such as Wealthsimple or Questrade. It is important to remember that the money you're placing within your TFSA has already been taxed. So once you've opened an account and funded the account, you're able to purchase a variety of securities within your TFSA. Now this includes stocks, bonds, ETFs, or mutual funds. Investment returns earned within your TFSA are not subject to tax. And to understand this concept, let's look at an example. Let's say you were to save $500 per month, and by the end of the year, you've contributed $6,000 to your TFSA. If you then purchase $6,000 worth of Shopify stocks, and over the next 2 years, the value of Shopify increases by 50%, making your initial investment worth $9,000, which you're then able to sell, you've earned a $3,000 investment profit that will not be taxed. Don't forget that you've already paid tax on the initial $6,000 contribution, so then you could withdraw the $9,000 total at any time and it'll be completely tax-free to do so. Unfortunately, you cannot place all of your money within your TFSA and earn unlimited tax-free investment income. The government sets limits on the amount of space that we're allowed within our TFSA. The space is the sum of 3 factors: the annual contribution limit of the current year, any unused contribution space from the previous years, and any withdrawals made in the previous year. The annual contribution limit is the basic amount of space that every person will accumulate at the start of each year. This number is set on an annual basis by the CRA, and you start accumulating space the year that you turn 18. If you were born in 1991 or before 1991, you would be eligible for the maximum annual contribution limit of $75,500 in 2021. Let's look at an example for a 26-year-old who has not yet started investing. If you had turned 18 years old in 2013 and up until 2021 had not contributed any money into your TFSA account, your contribution space would be the sum of all the annual contribution limits, or in this case, $55,500. This means that in 2021, you're eligible to contribute up to $55,500 into your TFSA and invest this money to earn tax-free income. The second factor used to determine your available TFSA space is the amount of unused contribution space from the previous year. Unused contribution space rolls over into the following year and is not lost. So don't worry, if you can't save enough money to max out your TFSA in 2021, you won't lose the space. It will just roll over into 2022 regardless of how little you contribute. The third and final factor is withdrawals from the previous year. This point is the most confusing, but also the most important because it allows you to actually create more space in your account. Good investors are rewarded with more space, while bad investors are punished with diminished space. We're going to look at a few different scenarios to see how this works. This is an extreme example, but helps just understand how the withdrawal rule works. Take someone who was born in 1995 and is 26 years old in 2021. If they had never contributed to their TFSA before, their available space would be $55,500 at the start of 2021. Let's say they contributed a lump sum $55,500 to their TFSA, leaving $0 remaining for 2021 space. If they use this entire deposit to purchase an ETF, which grew to $120,000 in just a couple months, and for whatever reason, maybe an emergency or they want to make a big purchase, they need to withdraw the entire $120,000 balance, leaving $0 in their account. What happens is on January 1st, 2022, they actually regain that space. Their available space becomes the sum of those three terms. First, the 2022 annual contribution limit of $6,000 plus the unused space from 2021, which in this case is $0, plus all withdrawals from 2021, which was $120,000, for a grand total of $126,000. Looking at a similar example, if this same person instead contributes and invests the $30,000, leaving $25,500 in remaining space, and the ETF increases in value from $30,000 to $120,000 in a matter of months, this time they only withdraw $40,000, leaving a remaining balance of $80,000 in the account. And on January 1st, 2022, their available space would then be the 2022 annual contribution limit of $6,000 plus the unused space from 2021 of $25,500 plus the $40,000 withdrawal from 2021 for a grand total of $71,500. So even though the TFSA account has a balance of $80,000 going into 2022, they actually have another $71,500 in available space to contribute into the account. One more example to look at what happens if you make bad investments. So if the same person who never invested before contributed $40,000 to their TFSA and purchased an ETF which diminished in value to only $10,000 in a couple of months, and for whatever reason they need to sell and withdraw their investment, their remaining account balance would then be $0, while their available space for the remainder of 2021 would be $15,500. And on January 1st, 2022, their available space would then be the 2022 annual contribution limit of $6,000 plus the unused space from 2021 of $15,500 plus the $10,000 in withdrawals from 2021 for a grand total of $31,500. So through poor investing, they diminished their TFSA space. On the CRA website, it outlines dozens of random rules regarding TFSA accounts. So I've pulled out a few of the most interesting and relevant ones to discuss. The first one is that you can actually hold an unlimited amount or an unlimited number of TFSA accounts through multiple different brokerages. However, the contribution limit is calculated using the combined sum of all your TFSA accounts. Next is that the CRA will charge you a fee if you over contribute to your TFSA. It is important to know how much available space you have at any given time and just be cognizant not to exceed it. The over contribution penalty is currently set at 1% per month. Another interesting one is that you can contribute to your spouse's TFSA. If one partner is the higher income earner and already has maxed out their own TFSA for the year, they can contribute to the money into their spouse's account to fully maximize every bit of the tax sheltering benefit for the family. The CRA also does not allow day trading within your TFSA account. They have the right to audit your account and make an assessment and revoke the tax sheltering benefits if they deem that you have been day trading. Finally, the CRA does not allow debt investments within your TFSA account. You're not allowed to pull out a line of credit and invest that cash within your TFSA. This is classified as a prohibited investment and it will be handled similar to day trading. When you do need to withdraw money from your TFSA, you need to think about when you're going to do that because there's a right way and a wrong way to do so. The best time to withdraw money from your account is actually at the end of the calendar year. And this is because once money is withdrawn, it cannot be recontributed until the following calendar year. So for example, if you withdraw $10,000 in February of 2022, you now have to wait until January of 2023 to regain the space. And if you had withdrawn that money in December of 2021, you actually would have gained that space back in January of 2022. The second type of registered investment account I would like to look at is known as the Registered Retirement Savings Plan, or RRSP for short. It differs from your TFSA as it both shelters your money from taxes and defers your money from taxes. So first off, let's look at how it defers taxes by reducing your taxable income. What happens is your employer will deduct before tax income from your paycheck and contribute it to an RRSP account in your name. And you could choose how much money you want them to deduct. And employers will often match this contribution up to a certain limit. Large companies sometimes offer RRSP matching as a perk rather than having a pension. And the total amount that you and your employer contribute to your RRSP account is then deducted from your total taxable income and corrected through the annual tax return. The current annual RRSP contribution limit is set at 18% of your previous year's gross income, and this is capped at an annual maximum contribution that is set each year by the CRA. As of 2021, the annual maximum contribution was $27,830, meaning that you would need to earn $154,000 and contribute the full 18% of your gross salary to cap it out. The contribution space is cumulative and carries over into the next year, similar to the TFSA. As an example, if you earned a total gross income of $100,000 in 2020, your 2021 contribution limit is now taken as 18% of $100,000 or $18,000. And if you were to contribute $10,000 in 2021, you would still have an additional $8,000 in space, which you would then carry over into 2022. Looking at another example, if you were to earn that same $100,000 gross salary and you were taxed, let's just say on average 30% or $30,000 throughout the year, and your employer made regular contributions to your RRSP account, resulting in $9,000 in savings. If you were to invest this $9,000 and turn it into, say, $25,000 for a $14,000 profit, this $14,000 would be completely tax-free. What happens is the $9,000 principal, or the initial investment, is now deducted from your taxable income for the year. So now you're only responsible for paying 30% taxes on your adjusted income, which results in $27,300 in taxes. And when it comes to tax time in the spring, since your employer had already deducted 30% in taxes for the government, you'll receive the difference of $2,700 via your tax refund. There are two super important points in this example that it highlights, and the first is that the RRSP account shelters investments from taxes on capital gains the exact same way as the TFSA. You put your money into the account, you purchase an investment, and you let it grow tax-free. The second point is that even though there are tax savings on the front end through reducing your taxable income, the CRA still recovers the tax on the back end. So when you withdraw the money, you'll be responsible to pay back that $2,700 in taxes. And this is why the RRSP account is known as the tax deferred account. Most financial advisors will direct young investors towards the TFSA rather than the RRSP. However, the RRSP has one particular use that can be super beneficial to a young investor. The CRA has a program known as the Home Buyers Plan, which allows young Canadians to withdraw up to $25,000 tax-free from your RRSP account, which can then be used to purchase your first home. There are some stipulations on this Home Buyers Plan though. It has to be a qualifying home, which means it has to be your primary residence and located within Canada. You also have 15 years to repay the $25,000 back into your RRSP account. And it's sort of like taking a loan from yourself. if you're not able to repay it back within 15 years, it's treated like a regular withdrawal and you'll be taxed on whatever balance you weren't able to repay. So we covered 4 key points on the TFSA account today. Number 1 is that income earned from investments within a TFSA account is not subject to tax. Number 2, there are annual limits on how much money you can contribute to your TFSA. Number 3, profit and loss on investments within your TFSA will affect the amount of available space. And number 4, the best time to withdraw money from your TFSA is at the end of a calendar year, as you regain that space back in January of the following year. We also covered 4 main points of the RRSP account. Number 1 is that income earned from investments within an RRSP account is not subject to tax. Number 2, there's also annual limits set for how much you can contribute to your RRSP account. And number 3, contributions to an RRSP account reduce the total amount of taxable income you're subject to. And finally, number 4, RRSP accounts can help to purchase your first home through the Government of Canada's Home Buyers Plan. At the end of the day, you have to decide which account is right for you. If you have an employer that is willing to match your RRSP contribution, it makes sense to put money into an RRSP account. But if you're just starting out with investing and you don't have any RRSP matching benefits, the TFSA might be your best bet. Do your research and talk to a financial advisor if you have access to one. But most importantly, understand how both of these accounts work so you can maximize the potential and take full advantage of the tax sheltering and tax deferral benefits. Thank you again for listening, and see you next time, where I talk about stock markets and stock indexes. And if you enjoyed this video, don't forget to subscribe to the channel.